and financial objectives. If at any time during the webinar you have questions or trade ideas, please type them into the chat box and we will do our best to answer them. Our presenter today is Mr. Adrian Mueller. He is the lead developer of the Option Ranger software and served as chief strategist of Dow Jones Megatrends and All Markets newsletter. Mr. Mueller is the founder and principal of the independent introducing brokerage, Time Leverage Capital, and a former stock option principal. The program in which you are participating was developed over many years to train professional brokers and to provide user-friendly educational programs for individual investors. Without further delay, welcome to our Panic Volatility Index, an answer to large-scale crisis webinar. Mr. Mueller?
Thank you for the introduction, Roy, and thank you all for attending. One of the biggest concerns that we see in today's environment is that we have an extraordinarily successful stock market and bond market in terms of price appreciation, and yet there's also a great deal of fear in the market which people have difficulty overcoming. This fear is very understandable because we are in an unpredictable environment, and the question is, how can one try to master their natural and reasonable fears and concerns in the market without missing out on the opportunity to participate in potential of continuing appreciation across different asset classes? So of course what we think is that it is natural for people to be afraid, but that there has to be a counter, and that would be knowledge. In the words of Ralph Waldo Emerson, knowledge is the antidote to fear. I would add in my own words also that knowledge sometimes is the antidote to information, which generally tends to confuse investors, and especially in the case of private individuals, get them on the wrong side of major and highly impactful moves in the market. So although history doesn't always repeat itself, or perhaps not in the same way as our disclosures will indicate, I believe it is one of the few points of reference on which we can depend to gather information and some opinion. So let's look at the last 100 years first, and as you can see, there have been significant spikes in volatility. The first grid here that you are seeing is the Dow Jones average, and the yellow background here is the measure of volatility. And as you can see, especially during major drops or incidents to the downside in the markets, we have seen very significant spikes in volatility. Most notably, again, this is looking at the very big picture in the crash of 29. As you can see, an extraordinary spike here, as well as in 1987. But what we really want to do is we want to go ahead and go to a more recent picture and notice again how many of these events were largely unpredictable. So let's go to the next comparison here, and again we're going to look at a slightly longer term picture, and you see here again when we had some, again this would be 1987, you see minor drops and spikes in the market, extraordinary spikes in volatility, and again, as we already begin to see, there's a correlation here that the larger drops in the market were accompanied by larger volatility spikes. The reason that happens is that most drops, as we will see shortly, are entirely unexpected. Much of the smart money says that all of the information that is available out there is in the marketplace, in the hands of the people who have the most immediate access. They act in the marketplace, so there's an assumption that, largely speaking, markets are efficient, and then it really takes unusual events to counteract the fact that all of the information is in the marketplace, all of the players are in the marketplace, so to speak. So what can move a market? And as we can see, for all the fear and speculation that people have, it is usually the unexpected event. And here we're just going to go back to about 1997. And as you can see, the Asian contagion. I remember all these events very vaguely. However, if you look at the drop in the marketplace, it was very significant on the heels of that Asian contagion and a significant spike in volatility. When you see these numbers, we'll illustrate it later. Every point is worth $1,000. It's a percentage point in volatility, annualized. So if volatility goes up, let's say it goes from 20% to 30%, those 10 points translate into $10,000 at $1,000 per annualized percentage point. And this is basically a measure of volatility that we'll go over later, but let's go ahead and see, first and foremost, to understand the concept, the nature of the types of events that move markets. Again, we see the Russian debt crisis. The markets seem to be very comfortably marching along with no anticipation, and all of a sudden this hit the market. We see another significant spike in volatility. First brick of the internet bubble, people thought the internet was going to move on forever. There would be the consensus belief was at one time that markets would go up, I believe, over double digits year after year. Some people thought it would be over 20% a year, without stop. There was talk of a new paradigm, and then the first brick of the internet bubble shocked people. Of course, there's no need to remind people of 9/11, which was an entirely unexpected event. People didn't even know what was happening before the first and second plane hit. Totally unexpected event, major spike in volatility. And so on with the subprime crisis, the ongoing collapse of the internet bubble and the NASDAQ. Of course, more recently, as recently as 2008, an extraordinary drop on the Lehman Brothers crisis. Of course, we knew nobody seemed to be aware of this. The system disintegrated behind the scenes, and even the federal government and the Fed, the president, the president-elect were all meeting on how to unplug the money supply to save the entire financial system from collapsing. Again, totally unexpected event. Nobody was talking about it the day before, except certainly people who are alarmists in the longer term, and yet the market wasn't anticipating it. People were complacently in the market, and then you see the extraordinary drop and the spike in volatility. And the same thing, worldwide credit freezes, the flash crash, which is exactly what the name implies. It was a technical glitch, yet the market took its drop, and the volatility index took a rally, and we'll do a valuation of these. And finally, the U.S. credit downgrade, remember it as being fairly recent, and although a non-event from the standpoint of the stock market and the U.S. bond market, it did create some short-term volatility, which could be viewed as a hedging opportunity or a spec opportunity. So let's look at some of the particular numbers, and as we can see, some of the larger drops in the market that, as you can see, we took some of the previous figures and took them to a corresponding drop in the stock market. And of course, courage is resistance to fear, master of fear, not absence of fear. So just because we have to concede that events are unpredictable, certain types of events are unpredictable, that is no reason to be out of the markets. It's just to accept the reality of that risk, to know that you can handle it, and then to be able to think of ways to participate in gains without incurring greater risk than one can tolerate. So as you can see here, we have a comparison. Again, this is going back to January of 1990 to the end of the previous year. And as you can see, it's not quite a mirror image, but we see great correlations, reverse correlation, if you will, to the behavior of the markets in terms of the stock markets. When they drop, volatility goes up. When they rally, volatility goes down. Basically, the volatility is a measure of fear or panic, and when things are good, people tend to get very complacent. That means that the risk premium goes out of the options, and then some unexpected event occurs. Everybody panics suddenly. They sell suddenly. The risk premium goes up in the options, and that's really the type of inverse relationship that applies much of the time. In fact, just a moment, let me go ahead and go to the next slide. Sorry about that. Okay, 100 years of volatility. We see the events, we see the percentages, and this is the instrument that we're looking at. I went over the premiums earlier, over the values and the tick values, which will make it easier to model out the trades as they come about. Again, we're looking at the volatility index, also called the Fear of Panic Index. It's traded on the Chicago Board Option Exchange, Futures Exchange. The contract is growing in popularity. The liquidity is going up. The open interest is going up. It trades every month with the greatest volume in the front month, and as we indicated, the contract size is $1,000 times the index, and the tick is 0.01 ticks at $10. The bid and ask spread is at 0.5 ticks. So you should be aware of how to trade those spreads. And again, we see here the inverse relationship, which is not a constant, but certainly as the market has become more liquid, is showing. And again, the relevance of volatility studies cuts across other markets, whether it's gold or oil or any other market. Now let's go ahead and try to model out some examples on the option ranger for a move, and then we're going to go ahead and proceed with the theoretical portion of the program. Are there any questions so far?
No.
Okay, now we're going to go ahead and go to our basic calculator and pull up an example on the VIX market. So let's go ahead, and again, the contract market. And you can either, for those of you that haven't used the program, you can go ahead and learn how to do inputs. You just input the first letter, and then there's a drop down that appears. In this case, it's the VIX. The minute the position comes up, the contract size appears, and the tick value appears per contract. This trading strategy is that we're going to buy futures, call and put options on VIX to exist in the equity market, so we can model out some option examples in that. Interestingly enough, since this is a volatility instrument in itself, this is a way of buying volatility without paying premium, if you will. Although there are some different contracts, so let's go ahead and have a look at the, let's pick up an example of one position. And as you can see, when we select the number of contracts and the contract type, an example comes up of how to input the price, the futures price in this example. And so we would go ahead and input the price that, let's say, would be somewhere close to the current price. So let's use the May contract as an example, which is the nearby month, and let's call it 1370. And we can look at some charts later on, or certainly you can contact us to see some of our close studies and spread studies on how to trade the VIX. We've been studying some spread ways to spread the market between different months and try to pick up a differential. Let's go ahead and factor in a cost so that we can see where we are. And now, again, as you know, every time we select a trade, the graphics, the profit and loss table on that transaction shows up. This is a futures, therefore it's a very straightforward position that loses tick for tick on a drop, gains tick for tick on a rally, and unlike an option, obviously if we made an option selection or a spread selection, then the visuals here would change to be in accordance with the trajectory of the trade between now and the expiration date or the exercise date. Let's go ahead and calculate this position. Okay, and in this particular scenario, as you can see, we have the plus, we have the minus. Again, the option ranger is a very objective calculator, so in order to be strictly accurate mathematically, as you can see, we have the drop of the VIX getting down to levels that we have not experienced and would require an unprecedented level of complacency in the market, unlike we have seen. In the cash market, 12 has been pretty much of a low for quite a while. Again, you can see a tick value here on where this would be on the futures market. You can also use cash market prices here. You will have the same outcome. And on the upside, as you can see, and the measure is in half a point increment or $500 increments, each of these representing a half a percentage point annualized of increased premium in the options. Generally, when there's fear in the market, when there's panic in the market, prices drop, people pay more money for options. It's the fear factor, and that additional premium that people pay in those options, or the premium itself, is measured by this index. The greater the fear, the greater the premium that is paid, the higher this index goes, the less the concern, the greater the complacency, the index goes down. So as we can see at these levels, and we can pull up some historical perspectives and model out different moves. Again, as you can see here, we're looking at an inverse relationship. Now this is as we get closer in the history of the VIX as a futures instrument on the SIBO, and as you can see, compared to some of those earlier tables, there's a significantly improved efficiency in the way that this index tracks, although not to a complete correlation, but to a fairly noticeable and obvious correlation between the S&P 500 and the VIX as a reverse correlation. Some people try to use this in the shorter term as a leading indicator for the movement of the S&P. I think it's a very interesting area. We're doing work in it as well, and I do believe that there will be some fairly good opportunities in correlating the two and cross-trading the S&P 500 with the VIX, because they are very closely connected through the option premiums that are trading in those markets. And certainly if we want to look at some major events in history, we can look at some of the movements that we indicated previously for market drops, and also in a corresponding way look at the VIX cash price change in that time frame. Now I want to be very clear at looking at examples like this that what we're talking about is a top to bottom crash in the market and a bottom to top range in the VIX. So just as unlikely as it is for somebody to be unfortunate enough to be in at the top and out at the bottom, it is equally unlikely for somebody to be in at the bottom or out at the top. What we're doing is we are showing the entire move in one market, the entire move in the corresponding market, and assuming that nobody is in or out at the exact top and bottom of anything. So the truth lies somewhere in the middle, but as you can see, there is a correlation at the very least between the top number in the VIX side and the extremity of the drop or the correction on the market side. So in this particular scenario, let's say from 1550, we're rounding up to 3650, let's call it 3550, would be a move of 20 points. We've already rounded a bit, so instead of going to 20 points, like when Iraq invaded Kuwait, let's see what a 10-point move would look like in the VIX. So let's go back to the option ranger and see just what a move from 1350, which is our 1370, which is our input price now, would mean. So we actually we don't have enough rows included. We only have, well, let's show first a move to 2370, which is halfway of the other move, would be a move of 99.65. So assuming that there was a half event of what happened regarding Kuwait, and this is just a kind of a generalization, not likely exactly the same thing would happen again, but if an event that is seen on a similar scale occurred, the VIX, if it makes a 10-point move, would be up just under $10,000 after all costs. Of course, on the other side, if as you can see, tick for every half a percentage point that the VIX goes down, the position would be losing $500, and In fact, let's go ahead and have a look at some shorter term charts so that you can have an indication of how this particular market can perform and how those numbers look, whether or not they appear to be realistic. And this is a VIX daily chart, as you can see. So let's, as you can see, we're having the highest numbers here. We're over the 20 level, and we are now they actually came off some lows. As we indicated, closer to about 1370. The market had lows under, as you can see, under 1330. So there were some pretty significant lows in here. The market seems to have held, but not that long ago. In fact, back in October, this contract was was close to 21. And as you can see, there have been various spikes. This one was close to 18. But in what has been generally a downtrend, which means that there's been increasing complacency. Now this complacency has been somehow shaken up, and one would wonder if the market can break out. In terms of the longer term history of this market, as you can see, we were hovering fairly close to the lows. There are some numbers that are below this level on the chart. But clearly there are some larger spikes in the history, so one has to consider whether we're not really near a bottom of volatility, or whether the complacency can further drive down the volatility index. But in all cases, you can see that we don't have anything here going back, and here we're going even back to 2008 when we had the large spikes. There's nothing really that we can see here under $10. So going back to the option ranger example, we would have to have really unprecedented levels of complacency. And even if we hit that, let's say that 10.2% level, the position would be, according to the option ranger, tick for tick down 35, including costs. So this gives you a sense of the risk parameters. Of course, you have all the theoretical numbers one way and the other. But on the upside, again, let's go ahead and have a look at the next level. We've already seen a move of 10%. Let's go ahead and increase the number of rows so we can look at the other example of greater volatility. Now remember, we've had volatility over 80 and over 100, and certainly over 60. So when you look at that long-term chart, I recommend you revisit that chart. And while obviously those are more significant events, there are events that have occurred, many of them within the last 15 years. Here, as you can see, on a greater move, let's say if the volatility goes to 20%, or let's use 20.2 since we're going in 0.5% increments, the position would be at 64.65. Again, at 20% over where we are now, would be 33.7. We're looking at 19,965 on the upside, and so on. Very simply put, if you have an extraordinary increase, which is a rare event, but as you've seen, they relate to unexpected and serious circumstances. If you have a spike of 60 points, then that would be strictly math, $60,000 that above your current level. And of course, that would require a major event or some major unexpected shake of confidence in the market. In terms of the way to trade these contracts, bear in mind you can use the current markets. You can also use spread charts, which are becoming a very important tool for traders who want to try to get in, get some better fills. So what we are doing now, and I recommend, I'm going to give you a little insight into how we work. We're actually monitoring a price scale with bid and asks and depth of market. This is on our QSD platform that you can have as well, and as well as comparing the different intramonth spreads, bids, and prices, so that we can take advantage of discrepancies in value between different months or between different market activity. examining the depth of market and being able to execute on this platform. I think it's a good way to set this up. It's kind of a custom screen, but you can duplicate it yourself if you want to use it on the platform. And of course, there are also spread charts that can go with that transaction. As you can see, there's a fair level of movement in the prices and the volatility expectations of the marketplace, and I believe that somebody who watches those markets closely can also try to capitalize on some of those shorter-term events. However, in the big picture, and I think it's always important for people to go back to the big picture, we want to make sure that we have the view in mind to proceed looking at these events in the big picture, and again, to cross the risk elements of the stock market with the correlation, the negative correlation of the VIX in order to manage portfolio volatility. Do we have any other questions on this, Roy, today?
Um, yeah. Would you use this in combination with an actual stock portfolio, or is there something you could do in index funds?
The correlation, there's a great correlation in stock prices today, more so than ever before, because of the advent of different ETFs and mutual funds and sector funds. So there is a broader clustering of prices, and there's a greater correlation. Over 80% correlation is the most common figure that I've heard between stocks. So to that extent, a volatility index can be used in order to counteract to some extent, to a certain extent, the level of risk in a diversified portfolio, because it's really a correlated portfolio with a lower level of diversification. A much stronger correlation exists and can be measured between the S&P itself and funds that perform and invest comparably to the S&P. So obviously, from the standpoint of greater correlation and perhaps a greater ability to try to anticipate results, you want to use the VIX with the S&P first and foremost. Secondly, with funds that are invested, or monies that are invested in instruments that perform comparably to the S&P 500, and then to a lesser extent with less and less correlated or negatively correlated investments. So presumably it will correlate to some extent against the Dow Jones index, but insofar as the Dow Jones, for instance, recently has outperformed growth companies and smaller companies, the correlation would be somewhat, and I would say fractionally less, much as somebody who would trade intraday a Dow Jones against an S&P position, or a basket of the two, so that they can correlate in some way. So, so certainly in the event of a major market event, if you look back at Lehman Brothers events, the market crashed, whether you look at the S&P, the Dow Jones, growth companies, international companies, you name it. 9/11, very much along the same lines, although they were different. So while you cannot always put a particular face on an unpredictable event, if it's serious enough to cause fear and panic, it in all likelihood will hit across the markets, and again, some more than others. I think that in today's environment, the VIX is probably one of the best instruments for protecting against market volatility, because it specifically measures volatility in an efficient way. Moreover, the premium cost of buying options, so buying S&P puts or Dow Jones puts, or doing put spreads or collars in all those markets, does not necessarily limit risk. To the extent that there's an expenditure of premium, so that the cost of the protection, if you will, by paying that premium may not be the most efficient way to protect it, whereas when you're trading an index, the movement is tick for tick on volatility, and certainly if there's a concern about time erosion or having to roll positions forward, that's where you have to come in with a strategy of spreading or entries and exits so that you can have the volatility protection in there and mitigate the cost of doing business. And that can be done in a variety of ways, as we've indicated. Of course, in a major event, you can have low volatility, roll positions forward for 2 or 3 years, but if you have one of those major events occur, probably the whatever costs are in there would be well more than covered by a significant move. And again, you'd have to look at particulars, and that's why the software is there, so that you can model out and say, well, if I'm going to lose 1 or 2 percentage, 1 percentage point over X period of time, how long will it take for there to be a big increase in volatility before I make it up and get my anticipated return? So I think the measure is there, and if you think the markets are too complacent, it is an alternative to use the VIX rather than pay premium for options, although that also can be modeled out and is more suitable for some people than others. And that's, again, in that scenario, we would look at it as some sort of an S&P put strategy in the case of the VIX or Dow Jones or any of the many indices that we have that we've already input in the program. Any other questions?
No, not at this time.
Okay, outstanding. Well, I want to thank everybody for attending. And if you have any questions, want to model out some particular positions or perhaps do some correlations against a particular type of portfolio and try to figure out some different percentage moves and how they might work against a portfolio, don't hesitate to contact our trading desk or the development group. And have a super afternoon, and I hope you got something out of our VIX program.